Hello, everyone, and thanks for taking the time and being here today in our third webinar related to the UBS Quant Hackathon 2020. So this webinar, like the previous two webinars, will be available on our Alphien channel on YouTube and on Alphien platform right after the end of the presentation. So please don't hesitate to share the link with your teammates if they could not attend this event. So let's get started. So this webinar will be a bit different from the first two webinars. First, because this time we will focus on the second competition, which is the machine learning for complex pricing model. But first, we would like to share with you a bit of statistics. So you can see here that the most represented university participating in the competition. And the next slide, you can see as well, since the winner will be selected by region. So you can see as well the participation by region, Asia Pacific, Europe, and America. And on the right side, you can see as well how the student created and composed their team since it was between 2 members and 5 members. So secondly, we have today 2 presenters from UBS, which is the sponsor of the competition. So the first presenter will be Vinay Srinivas, head of quant analytics and digital transformation in Asia Pacific. He has been working for 12 years for UBS and is currently based in Hong Kong. So he will talk on the quant setup in the UBS investment bank in various departments, how quants contribute front to back in various initiatives, and as well on the structured products market, which is part of this second competition. And the second presenter will be Alexandre Cohen. He has been as well working about 10 years for UBS, and is also based in Hong Kong. So we will present the equity derivatives quant team in Asia Pacific, the models for path-dependent products, and it will end up with non-parametric modeling for fast quotation, which is really the prime behind the second competition of this UBS Quant Hackathon 2020. So, this current presentation is done on the Alphien platform. So there will be a Q&A session at the end of the presentation. So please ask a question on YouTube. We will group your question during the session, during the webinar. So during the webinar, if we don't have answer your question during the webinar, please go to Alphien website and ask your question on the forum. We will prompt to answer them. So no further ado, I'm gonna pass.
Thanks, Philip.
Yeah, then I'm going to pass to Vinay.
Hey, thanks, Philip. So everybody, welcome to the webinar. Just excuse us both for Alex and me. It's one of the first times that we're doing this kind of webinar face-to-face, but we are very excited about this competition. So the Quant Hackathon itself is we're very excited about this because we get to interact with strong talents like you. And often the question that comes out is, what do the quants really do in a bank? Well, why are we having this? So and the quant name itself has become very kind of widespread now. Quant could be I'll come to different types of quants, but there could be a modeling quant, there could be a data scientist is also a quant, there could be a quant trader, there could be a quantitative salesperson. So in effect, what's happening is, as and when the banks are evolving, and they're evolving very fast, even though it doesn't show very much externally, the banks are evolving very fast because of just the FinTech environment that's actually coming through. The way things are evolving, it's happening a lot faster than you actually see from externally. So quants are central to investment banks. Quants are involved front to back in algorithms for trade executions, trading strategies, models for pricing and risk management of financial products, settlements, and counterparty risks. So when I started my career, as Philip mentioned, 12, 13 years back, before that, I was also in a bank. I was working in technology. Since then, things have worked quite differently. Things are evolving really in an exponential basis now. So what we see now is that any technology that comes in, it's just because the banks have a lot of spend on the technology side of things. For example, a typical investment bank could be spending as much as $3.5 billion US dollars annually in their technology. So when we say technology and when we say quants, it's all kind of intertwined. The main reason is that without, at least especially in the investment banking, and when I say investment banking, there's two components in there. There's the market side, and there's also the banking, the M&A and IPO and other things. But on the market side, it's very competitive for the quantitative talent, because it's just the way that we evolved. The number of departments that we have, the number of products that we have, the financial products that we have, the number of optimizations that we need to do, the number of client interactions that we do, and how we expand our wallet, how we expand our margin, actually margins are really compressing. So how do we actually make it more efficient? That's where all the quant work really comes into picture. So I'll just briefly go through different kind of setup that typical investment bank would have, and probably this is a lot more true for UBS. In the markets world, you have usually have the electronic trading side of things. Then you have the where you actually go and build a lot of the quants go and build a lot of algos. Like it could be a VWAP or a TWAP or execution algos, where you say, I want to get the best execution for the clients given some constraints. So you come up with products and you try to say, okay, how is it actually? Then you also need to say, okay, how did the market execution happen? So that's the first area where actually there's a lot of things that, and then when you actually see, okay, for example, in the US, there's multiple venues for the same stock to be trading. How do you optimize which exchange it goes to? Where do you actually go and say the market impact that comes because of your execution? How do you reduce that? Or how do you actually not be on the wrong side of the execution? Do you go and buy on the bid or the offer? How do you do that? Where do you wait? What kind of risk do you carry not doing the execution immediately? So there's a lot of constraints and conditions that go into that, and that this needs a lot of quantitative skills. You also need to, for building any of your models, obviously you need to go and build a lot of historical data as well. And this is where you collect every tick, every order book change that actually happens in the electronic world, and you try to build models on top of that. So that's the first area. The second area is the derivatives area. And this is where you come up with a lot of financial products. You can also have low latency trading systems there, where you actually go and try market making for listed options, or you could be market making for the warrants, for example. There's a lot of products to be done. You could be market making for bonds. You could be market making for credit derivatives. There's a whole lot of gamut of things that we could be doing. That is again very quant and tech focused. And this is again similar things to as the execution and the electronic execution side of things. You need to have a lot of historical data to try and build your models. Even though the models would be a mixed here now, you'll be doing the execution models. You also would be doing pricing models. How does my volatility move if my spot, my underlying asset price moves? What does it happen when the option is out of money? What does it happen when option is in the money? How does it move? Intraday, how is it moving? How do we go and look at our volatility through the day? So these all comes in part of the derivatives world. Apart from the market making activity that I mentioned, there's also going to be there's a lot of financial products that come in. So you can say, are there any, we're going to cover structured products in detail later on, but how can you enhance the yield for the end customers? For example, all the because of all the COVID-19 situation, all the interest rates are at all-time low levels now. But how do you actually, if somebody has some money to invest, how do you actually tailor a product so that they can get slightly better interest or yield on the products, on their money? So there's different kinds of products that you can go and tailor that. So structured products is a bit of a mass product, but there's also other products that you can be coming up with. You can say there's something called quantitative investment strategies, which I guess Alphien has covered in detail, but there's also what kind of strategies can you come up with? How can you actually rotate a portfolio of your strategies? There's something called risk premia. How do you create smart beta products? How do you actually rotate them? So there's a lot of different things that's actually happened in the derivative space as well. Again, what happens in the derivative space is also these derivatives are also, they take some of the balance sheet. So what do you need to do on the balance sheet side of things? How do you optimize your balance sheet? It all seems like balance sheet is a very accounting kind of problem, but in reality, there's a lot of quantitative analysis that needs to be used for that. There's a lot of different kinds of analytics that you need to use to go and see, okay, how do I actually, for a given set of risk, how can I optimize my returns on that? So that's the derivatives area. And the third area that all the investment banks tend to have is the prime financing or prime brokerage in some areas, or financing area, where you actually provide financing to the clients, where you say these are the things that we need to be doing for our clients. How do we actually provide balance sheet to them so that they will be able to leverage their own balance sheet with us to get more returns? What kind of services do we provide them? So there it actually becomes very important when what we call is the resources. For a given client, how much is their utilization of the balance sheet? How much of their returns are they getting there? How can we help them? What kind of risk do they have on their side? Then on the same side, you also need to say, okay, you've got so much inventory sitting with you from the inventory that the clients brought in, from stocks, the bonds, the repo, and everything. How do you go and optimize that? How do we actually manage the inventory? What kind of funding we should be charging on that? So there's again a entirely different set of quant skills required there. And this is again very evolving area, and this is a very again, as I mentioned earlier, these margins are compressing. So the more smarter that you are, the better you are. If you have something, the bonds and stocks sitting with you, how do you use that as a collateral? So all these areas, everywhere, it's the quants that's required. And again, there's no kind of distinction between quants, quant traders, strategists in some banks. Quants are involved front to back everywhere. And again, all the three pillars that we discussed and the global markets area, everything's very, very data intensive, very analytics intensive. The fourth pillar that we have, and this is the research area. Traditionally, research included a lot of people going and doing interviews and writing about companies with fundamental views and things like that. But now, as you might know, this has evolved quite a bit as well. Now you actually go and collect data from satellites, alternative data sets, and you try to build some models and say, okay, this is what we think is going to be happening in the market. This is what we think is going to be happening there's a macro view in each of the countries that's going to happen, what's going to happen to the companies as well. Again, that's the fourth area as well. There's a lot of quantitative analytics involved, or the quantitative skills involved. So when we were designing these competitions, we were actually thinking about various things. So the first competition that you heard about, that was more in terms of the investment strategies. So how do you go and outperform the S&P 500? But the second one, so that's more in the in the investment strategy space. The second one we are looking at is the modeling side. So the modeling side, again, the problem is there's never a textbook model that you can actually go and say, okay, I'm going to go and implement that, and this is always going to solve our problem. You are trying to model a market that's evolving rapidly. You are modeling a market that's actually very prone to changes in the social situation, prone to changes due to the economic situation. There's all those things. It's not just you can think about just as a single line. When I was talking about electronic execution and derivatives, they're all kind of interlinked as well. Sometimes you see depending on what things are happening in the option market, it could be affecting what's happening in the stock market as well. So there's a lot of things that needs to be considered, and it's just the where you visualize this, where you understand this, where you model this. That's the differentiator for all the banks. That's why there's a bit of competition amongst the banks to get this kind of technology, this kind of analytics built into that. And just on that, so I'm repeating the same thing, but the big data, machine learning, and AI into day-to-day problem solving is critical. Without that, we cannot evolve as fast as we want to be. And the quants are the people participating in this hackathon being our best place to apply this data science techniques, because in some way you have both mathematics skills and the system skills. And this is where UBS is in the forefront of FinTech revolution in Asia, Europe, and US as well. So there's a lot of things we are doing, which is probably not as apparent from what you've seen in news, because quite a few of these things are done internally and not publicized as extensively. So that's that's what I wanted to cover in the quant setup and what all quants do. And then the other area that we was going to. So I think if you got any questions on this, I think we can leave it for later, and we can actually tackle it from there. The other areas that we were going to cover was the what kind of
or maybe Vinay, I can just ask a question. Thing is, where do you think you guys talking about quantitative strategy? Where do you think is going to be more and more important in the futures versus fundamental trading?
Yes. Okay, that's a very good question. Thanks, Philly. So the main idea with the quantitative investment strategies is that you have calibrated your risk very well on this. So when it happens to the fundamental trading, it's really you're looking at the balance sheets of the company and doing all the calculations and say, okay, this is a long-term holding that we want to do, and the rotation of your investments in there is probably not as scientific. There's still an element of human thinking that's going into there. So there's still a if and when and how, all those things are still there. But what we do in the investment strategies world is all more signal based, and these are tried and tested signals that we can actually say, okay, this is my risk premium going on there. This is my risk factor that I see in there, and this is what I actually see. Okay, these are the signals that's coming out of that. There's a lot of data and testing that's been done on this, and what we have seen is the main thing that people try to do is that you actually go through different market regimes. Everybody talks about 2007 financial crisis. Now people are including on also the March, April COVID-19 related market shocks that we have. So the advantage with this is you get a rotation of strategies as well. So you can have a strategy of strategies. So there you can actually say, we assure you, these are there's a lot of different techniques to put on that. This is the target that we can return, that we can give you. And the whole strategy itself will have so much of volatility as a cap. So there's different constraints you can place as well. So you can actually tailor make this to your investment needs. And that's where it becomes a bit of an open problem as well. Not just as you can just go and solve as a fundamental thing. I think this is good. I'll go and invest in that. And that's why I think this is one of the very interesting parts of things. And this is becoming more and more widespread. A lot of institutions, bigger institutions, are getting into that. It's only a matter of time when these investment strategies are packaged into smaller products, and you can actually start selling it to retail clients. So it's only going to grow bigger and bigger. It's also good for the clients and also the investment, because it's all very formulaic. The risk that you carry, the shocks that you can get from the markets is actually limited. You've actually tested it all. So I think that's and it's also the outperformance and the different indices on the general market is also well documented. So there would be things like crowding and other things happening, people getting into the same strategy, causing markets to shift a little bit. But in spite of that, these are the kind of strategies that will actually be the long-term cornerstone for big institutions and eventually to the retail people as well.
Okay, thanks, Vinay.
So that was the other area that I was going to cover was so we covered how quants are set up, or how the departments are set up in markets area, and we also covered the research area, and then we said, okay, how quants contribute to front to back in various initiatives. What I didn't cover actually as across the departments was that you also need to go and see what's what we call the resources. What is the credit risk of all the portfolio that we have traded with our clients? What is the likely biggest loss that we can actually have if the market tanks or market goes other way? How do we actually risk manage these? So for risk management alone, you can actually have risk management on an individual trading desk level, but that's a kind of a micro risk management. But you also need to have on the firm level that things move so much, equities move so much, the bonds move so much, the credit derivatives move so much. Overall, how are we managing the risk as a big portfolio? And this is where there's a lot of risk quants involved as well, risk strategies involved as well, and where we actually say, okay, this is we need to build a lot of models in there. Again, VAR, or value at risk, is a common one, but that's also evolving really fast. There's, again, credit risk. How do you say what is happening in the counterparty risk that the banks own? So there's various areas, front to back, everywhere. So you start from okay, what is the best price to quote? Then once you quote, how do you best price to quote to include all our hedging costs? What's the best price to get the trade? So that includes our risk management costs. Once you get the trade, how do you actually risk manage it through different market regimes? And then you also need to say, okay, what is the best utilization of the inventory that's come through? How do you settle it best? And then you also need to look at the counterparty risk. You also need to look at the market risk. You also need to see how much of resources we are using. So all these things is front to back, everywhere the quants are involved. So the last topic that I wanted to cover, so I think I've gone over time, is structured products market. So traditionally, again, as I was suggesting earlier, structured products is a way, at least in Asia and Europe, this is pretty big because there's a lot of private banks. Even private banks need to offer yield-enhancing products to their clients. And when you cannot do it without a bit of an alchemy, so what you need to do is you need to be mixing options and bonds and things like that to come up with a higher yield, so that the client can get a better return on their investment. So that's where all the structured products come in. So you could be, I'll just say a few names so that just people can carry that. There's something called an accumulator, for example, where you actually say, okay, if you have a strike price on that, if the stock price is above a strike, you get so many shares. You accrue so many shares. It could be double some leverage there or no leverage there, or you could have a knockout on this structure as well. We say as soon as it goes above a certain level, the trade stops to exist. So that's called an auto call. Or sometimes the client could actually say, I'm going to call this. So this callable products as well. Or sometimes the bank can say, I'm going to stop this product. So there's a lot of combinations of these features that you can put together. The basic design behind all those things is that you need to have a model behind it. There's a cost of providing an option to somebody, or there's either you're buying or selling. You need to price those things. But the main thing is you need to start putting all these things together to tailor a financial product that gives that. So this product has been very interesting. It's a major product for a lot of private banks and catering to their high net worth clients or even medium net worth clients. And this is where it's also gone retail. Some of the retail banks also go and sell it to their retail clients as well. So the idea is that accumulator was one example. There's also other things that you can have various features. So as a quant, what you get to see is that you are combining different products or different features of a product, and you say, okay, what is the impact of that happening? Or how do I go and combine that to give a better returns? Or we know this is a high dividend yielding stock, or this is it's a tech stock, it's a high volatility stock. How do we combine that, building into taking the small building blocks and give a structured product? And that's the part that the structuring quants do, the structurings or the strategists do that. This again a very interesting way that banks rely on. So and again, to understand these products and risk manage, you need this quant talent again. That's the structured products trading team that actually does that, apart from the market making teams that I mentioned earlier. So there's various areas that this structured products business is fairly pervasive. It's a big flow. This also gives you kind of access as well for somebody in say Japan wants to go and have exposure to some of the tech stocks in US. They can actually do through structured products, because they can actually go out and buy a product that says something with stock A, B, C from US. Some of the tech stocks, I'm not going to name them. They can say, okay, I'm going to buy some structured products based on the performance of the FANG stocks, for example. I can get this much returns. So you can actually start tailoring this. So this also opens up it becomes an access product as well. So that's where the structured products become really important. That point, I'll close it. Yeah, thanks.
Thanks, Vinay. So yeah, you mentioned about accumulator, and I know it's very popular. I mean, structured product, especially as well in Hong Kong. So I know as well, Alex wants to talk a bit about the path-dependent model, and accumulator is one of them. So maybe, as well, Alex, is a bit time for you to talk about the topic you want to mention today. Thanks, Vinay, again for your speech.